Most people who convert a traditional IRA into a Roth do it the expensive way. What they do is they take a big chunk in 1 year and they push it into the Roth and they jump up in the higher tax bracket. They trigger Medicare surcharges and they pay the IRS tens of thousands of dollars more than they needed to. There is a better way, and it starts by eliminating this concept of the one-time conversion of a traditional IRA to a Roth. And today we're going to break down exactly why spreading Roth conversions over time, maybe multiple years, is a better way than the one-time conversion moves. And I'm going to give you 7 reasons why this matters to real retirement plans. This isn't theory. This is experience. Let me bring in my co-host, Tony. Tony, welcome to the show. We're talking about Roth conversions, and I'm going to go through 7 points. Are you ready?
I am ready. This is a hot topic you've got a hot take on a hot topic once again.
We'll see. Okay, let's start with the first one, Tony.
All right. Number 1, you stay in lower tax brackets instead of jumping into higher ones.
This is the obvious one.
Yep. You fill the lower brackets year after year and avoid the 32, 35, 37% rates, right?
Yeah. So the tax brackets are 10%, 12, 22, 24, 32, 35, 37. So everyone knows this. They're trying to avoid taxes. That's what a Roth conversion is about. But you have to pay taxes the year you convert. And if you convert a big chunk in the beginning, you're going to push yourself potentially in that 32, 35, 37. You might even go from 12% to 22, which is a 10% increase. So this is the main problem with converting all at once. You're more than likely going to push yourself into the next tax bracket that year. And if you're converting 500,000 of your IRA 401k into a Roth, that could be $50,000 of extra tax that could be avoided if you just spread it out. So that's the key. Spreading out the same amount that you're going to convert, just spreading it out over multiple years, staying in a lower tax bracket. That's what I'm saying is one reason why spreading it out makes sense. Of course, though, Tony, for everyone, there's a caveat. And I'll tell you, in reality, we did a big conversion. We, meaning my wife. When she left her job, she had a 401k. And the year after she left, we converted the whole thing in one lump sum to a Roth.
Really?
And yeah.
Didn't it create a huge tax bill for you?
It didn't, because she was no longer working. And I happened to be in between jobs at that time. So that year, we didn't have a lot of income, and we were like, boom, let's do it. So we were able to convert her Roth to a Roth, her 401k to a Roth, without bumping into those high tax brackets because our income was so low.
Sure.
Right. So there's always a caveat on all of these. But I just wanted to point that out. In reality, the jumping to the next tax bracket may not be a thing if your income is really low that year. So these aren't hard and fast rules, but these are the 7 keys that I want to bring up to people.
Yeah. So number 2 on the list is you avoid or sharply reduce Medicare IRMAA surcharges, right?
Yes. Mean Aunt Irma.
Yes.
You should check that polka out. Mean Aunt Irma.
I love that
Polka
one.
Party Volume 1, I believe. So IRMAA, income related monthly adjustment amount. That's what that stands for. Means if you make above a certain threshold, you're going to pay more for Medicare. So this is only going to be relevant to people on Medicare, right? So 65 and up typically. And the interesting part about those surcharges are it uses income from 2 years ago. Mm-hmm. And that includes a Roth conversion. So if you do a Roth conversion as a lump sum, you might bump yourself up into IRMAA 2 years from now and get hit by paying more for Medicare. And the interesting part about those surcharges is it's a cliff. So you go $1 over that limit. So if the limit's $106,000, say, if you go $106,001, you're paying an IRMAA surcharge. $1 is all it takes. So it might make sense to spread the Roth conversions over time to avoid a IRMAA
Yes.
and Medicare surcharge.
Right.
Yeah. But again, caveat, if you're already in that bracket, meaning you're already going to be paying IRMAA surcharges, and it may not matter, right? So what you look at is you look at your tax tables, and then you look at the IRMAA tables, and there's a chart. And if you're in that before that first IRMAA chart level, and maybe the first, second, and third tiers, it may not matter that much if you're already there. But the last thing you want to do is be bumping up into IRMAA and paying $5,000 more a year for no reason, other than you could have converted over time and avoided all that. So
Yeah.
but sometimes it doesn't matter if you're already there. If it doesn't, just you got to look at those tables. Most people don't even know IRMAA tables exist until they're getting hit with it, right?
Yeah.
So
Right.
think ahead.
Yeah.
And it goes back 2 years. So 63 is when you should be worried about that for 65. 2 years later.
Because they do a 2-year look back, IRMAA does. So, and
Yeah.
that's why it blindsides people, because they do it, and then for the next 2 years, their things are fine. Their Medicare Part B premiums are the same, but then all of a sudden, the third year, oh, we did a 2-year look back. Now we're going to raise it from $202 to $500. It's like, whoa,
Right.
$500,
Right.
and that's a month. That adds up.
Right. Yeah, exactly. So be aware of that. That's reason number 2.
All right. Reason number 3 is you minimize the taxation of Social Security benefits.
Yes. So Social Security is taxed. We've done shows on that.
It's still taxable even
It's
after
still
the big,
taxed.
beautiful bill.
Right. It didn't get eliminated.
No.
It didn't. That's a lie.
Yeah.
Social Security is still taxed. Now you get the one big beautiful bill $6,000 senior bonus deduction,
Per
which
person.
grandfathers and goes away. It goes away
Yeah.
right now. So what happens is when you do a Roth conversion, Social Security looks at that as income, right? If you take money from an IRA, which is what you're doing, you're paying tax on it. That's considered income, and
Or a
that income
401k.
goes right.
Any
And that goes in-
traditional tax deferred retirement account we're talking about here.
Right. And if you're doing a conversion, you're paying the tax now, and that's
Yes.
considered income, and that's considered part of the provisional income formula. So you got to know this provisional income formula for Social Security. And the way Social Security works is 15% is always tax-free. Well, I won't say always. Currently, 15% of Social Security is tax-free, which is why I like Social Security.
Yeah.
But 100% of your Social Security benefit can be tax-free if your income is low enough. So you need to know what the thresholds are for a married couple, for a single person, and stay below those. And when you do a Roth conversion, it's very, very easy to jump up into the provisional income tax bracket, where now you're paying, instead of paying 0 taxes on your Social Security, now half of your Social Security benefit is taxed, or up to 85% of your Social Security benefit is taxed. Right. So it's for it's for a very strict subset of people in that Social Security provisional income tax bracket range. And people don't realize that. And all of a sudden now they're paying a whole bunch more in taxes. They're like, I get paying taxes on the Roth conversion. I understand that. But why am I paying so much more on my Social Security in taxes? And it's because you did a conversion, and now you're paying more tax on your Social Security income. Again, though, caveat, Tony, if you're already at that 85% of taxable income, it doesn't matter, right? It's not going to increase your taxation on Social Security anymore. And a lot of people that are doing conversions are already at that 85% level. So it doesn't really matter. But it's for the people that are below that where it's very important. So that's something to keep in mind.
Yeah. Oh, that's huge. All right. So now we're on to number 4. And this one is great. You gain real flexibility if life or tax law changes, if you have a major life change or the tax law happens to change, right?
Yeah. A prime example is the one big beautiful bill you just referenced, right? President Trump added a $6,000 per person deduction, senior bonus deduction for people over 65. So if you converted before that, and now you and your wife or you and your spouse are getting 12,000 more bonus deduction, you're like, well, I should have waited because I could have converted and get an extra 12,000 at that lower bracket, right? So once you do a conversion, you're locked in.
Yeah,
and that's it, right? I mean, you can undo it that year, but after that, there could be changes to tax law. There could be changes to your situation. You could lose a job, or your spouse could lose the income like we did. And it's like, wow, we don't have any income. Now let's do the conversion now. Oh, we already did it. We did a big one-time thing, and flexibility is gone. That's why I believe in flexibility. I like this one, and it's loose, it's loosey-goosey, but I think it's huge. To have flexibility in your retirement plan is important. This is probably the main reason why I like to do conversions over time as opposed to once ripping the Band-Aid off.
Okay.
However, caveat, Tony, if you're 71 or 72 and you're staring down the age 73
RMDs.
RMD age, it's like, all right, I have very limited time to do stuff, so maybe I'll do it now. And you might rush a little bit there.
Sure.
But that's going to be the main caveat to the flexibility. And the reason why you're ignoring the flexibility is because it's too late. I mean, the rules are the rules. So you got to do what you got to do. But
yeah. Yep.
Yeah.
All right. Number 5, the tax bill is easier to pay from non-IRA money. And they always say, you can't use the IRA money to pay the taxes on the IRA. Why do I always hear that? Is that what you're saying here?
Well, you can use it, but the rule of thumb is don't. Because what you're doing is let's say you take $100,000 out of your IRA 401k and you put it into the Roth.
Yep.
You could take that full, there's no limit. You could do the whole thing, right? But you're owing the taxes on that year. Now, you could take some of the money from the 100,000 to use to pay the taxes. Let's say it's 22%. You could take 22,000 out, but now you're only converting 78,000 instead of the full 100.
So you're depleting you're depleting your retirement money that you're going to be needing later, and you're canceling out a lot of the growth you've had. That's why.
Right. And then the future growth, right? So now you're going to be starting at 78 instead of 100. So all this future tax-free is going to be lower because there's less in the Roth now.
Which takes away from the advantage of doing it in the first place.
100% agree with you on that, Tony. That's exactly right. Takes away the advantage. It may not even make sense to do it if you have to use the IRA money to pay the taxes.
Yeah.
So typically it makes sense to use non-IRA money that you have checking, savings, a brokerage account, whatever, to pay the taxes because it makes it more powerful. So people, well, I don't have that. I don't have 22,000 in my bank to just give to the IRS. Okay, then let's spread the Roth over time so you can manage the tax bill and keep it, right? So that's my thought on that.
Roth over time. Yep.
Right. But the caveat is, well, if you don't have any ability to pay the tax from outside the IRA, well, then it doesn't, then doesn't matter. But then going to your point, does it even make sense to do the Roth in the first place? Maybe not. Just depends. You got to do the math.
Yeah. All right. Number 6, you still shrink future RMDs without overpaying today. That's a good one. That's a good benefit.
I mean, that's the one everyone talks about. The RMD. Everyone knows
there's no RMDs with the Roth. So if you convert the lump sum, you're really reducing the RMDs that you'll have to pay taxes on later and that you'll have to take. Yeah.
Yeah. So RMD, required minimum distributions.
Really massive donut.
Yes. That starts at 73 for most of the listeners, 75 for a lot of people too that are watching. So at that age, you're forced to take from your IRA. The government does force you. If you don't, they penalize you heavily. So you're going to take money out. But if it's not in an IRA, if it's in a Roth, you don't have an RMD. You're not forced to take it out. And people like that. So they say, wow, let me just do all of it, rip the Band-Aid off. Now I don't have any RMDs. Isn't that great? I don't have to worry about taking money out later. Yes, but... and that is the reason why a lot of Roth conversions happen.
Yeah.
But that doesn't mean you need to do it all at once. You could still do it over time because it's a tax play then. Why convert all of it if you're paying 36% tax? Because later you might be in the 12% tax bracket.
Yeah.
See,
true.
The goal on this the whole podcast is about Roth conversions. And a lot of people feel like I want to convert it all. I don't
Mhm.
want the government forcing me to take my money. Wouldn't it be great if everything I had was in a Roth? Yeah, it would be nice. But if you're sitting on a big chunk in your 401k IRA, it the goal isn't to take it all and put it into a Roth, because eventually when you retire and your income comes down, you might find yourself in the 0% tax bracket.
Wow.
Prime example, Tony. Let's talk about you for a minute. Let's say you have 100,000 in your 401k and that's all you have. And you're like, I got to convert. I got to convert. So you just convert the whole thing and now you paid, we'll call it 22% tax on it, right? And then you turn 73 and all you have for income is your Social Security. But you have this huge Roth. It's grown to 200,000. You're like, this is great. I don't have to RMD. I am loving life, right? But let's say you're now 73 and all your friends are forced to take money out and you're not. But your only income is Social Security. What's your tax? You're in the 0% tax bracket,
Probably zero, because
right?
especially with standard deductions. I mean,
Standard deductions, right?
yeah,
So you converted at 22% because you thought that was the right thing to do and you feel good about it. But now, wouldn't it be nice if you had 50,000 in an IRA and you were forced to take 5,000 out or 10,000 out or whatever amount you wanted and not pay tax on it? Well, I don't like the big bad government telling me to take money out. In your case, you would want them. You take it out anyway because you'd be able to
sure,
maximize your 0% tax bracket or even the 12% tax bracket.
sure.
So this idea of converting everything is wrong. You need to convert enough where the tax play makes sense down the road. Again, that's hard to determine, but you could do it. I do it all the time with people and start figuring this out. Don't try and convert everything. Convert what you need to keep taxes low throughout. Don't convert just for the sake of converting. You might actually be causing more harm than good. That's the caveat on that.
All right.
Because people don't realize tax brackets can be lower in the future. Everyone assumes the tax is going to be higher. Yes, brackets might be higher, but your income might be lower.
Yeah. Yeah. You have to look at your own situation, do the math. And the only way you're really going to figure that out effectively is to work with a trusted financial professional who knows this, has gone through this process. And that's where a financial advisor who's trustworthy and a fiduciary comes into play, right?
Yeah, and they should be looking at all 7 of these. They
Yeah.
really should
Yeah.
when you're doing it, which is
And
hard
not
to do on
everybody
paper.
does. You got to be careful, because
That's right.
not everybody's going through this. Yeah.
Right. And the TikTok videos or the quick little snippets, oh, convert, convert, they're not factoring in all these other things, IRMAA, and like this last one, number 7, you're reducing your
Yeah.
exposure to other income based cliffs. So
Okay.
you have the net investment income tax. So you pay a tax on investment income at a certain breaking point on income levels, so tax tables. You pay a higher capital gains tax rate. Capital gains tax rate start at 0, goes 0, 15, and 20.
Yep.
So you might be putting yourself from going from 0 to 15 or from 15 to 20 just because you're doing conversion. And other income that you have, an investment income, gets taxed higher.
Hmm.
Now, again, caveat on this, Tony, not a lot of people have other investment income. So this
Right.
is only specific credits that are in play, and it's only relevant to people that have retirement income, investment income outside of their retirement accounts. But so it's a smaller advantage, but I put it on here because it still applies to a lot of people.
Yeah.
And it doesn't eliminate the first 6 reasons either.
Right.
So let me just wrap up with the
Sure.
7. You have lower income tax bracket, which people, they get that because they know, oh, if I convert it all at now, I'm going to get bumped up to the higher bracket. Don't get roped into doing it all at once.
Yeah.
IRMAA surcharges, Social Security gets taxed higher. People forget that. You want to stay flexible. So just because you might be able to do it all this year, maybe, you never know. Things might change. Maybe your life situation changes. It's good to be flexible. Once you do it, you don't have no more flexibility. Even on the other end, all of it in the Roth isn't necessarily the best thing. You got to make sure the tax bill is manageable. Make sure you can manage the taxes today by using other money to pay for it. That really makes the Roth shine. You're shrinking future RMDs. That's a great way, but make sure you're shrinking them over time. You don't have to go all or nothing.
Right.
And finally, staying clear of those income cliffs. So that's it, Tony. I think
Wow. It's a lot.
most people convert I don't have data on it. In my experience, though, in talking with people, most people, when they talk to me about conversions, hey Dan, I heard about conversions. Let's talk about it. They feel like they have to do it all at once. They feel like, oh, I got to do it at a certain age or only a certain time.
And over
Or
time is really the smart way,
right,
but depending on the situation, like you talked, there are caveats to each one of those, but there are so many reasons to be strategic about it, have a plan on when to convert and how much to convert. And the lump sums, how many people have, oh, I've got 30,000 to pay the taxes separate from what I'm taking out. Not a lot of people want to do that or have that just sitting around in cash extra, right? You don't want to
right.
raid your emergency fund for that. You need that. You don't want to raid another retirement account for that. You got to look at that smartly, don't you?
Yeah, exactly.
Yeah.
It's unique to everybody, right? It's unique to their tax
Yeah.
situation, their future tax situation, their future cash flow, their current cash flow. I mean, I think what happens is people get really roped into the concept. I got to convert because that's the cool thing to do.
Oh,
Susie Orman
it's the
says this
hot thing
or
right now.
whatever.
Roth
Right,
conversion, Roth conversion.
right.
You hear about it everywhere. Financial planners are just pushing it. Talking heads on TV do Roth conversions.
And I'm going to say it doesn't make sense for most people. Like everyone's, oh, Roth conversions for everybody. No, for a lot of
Oh no,
people, it doesn't make sense.
no.
If it does, it's usually drips and drabs over time. A strategic Roth conversion over time is the way to go. The problem is it's harder to do that. It's a lot easier to just do it all at once, right? But that's not the most effective.
Right.
So it takes every year doing the math, and not a lot of people want to do that. Financial advisors included. They
Yeah.
don't like a lot of, the broker is not going to be like, oh, you want to talk about this again? Let's just get it done, right? No, let's do the math every year.
So
Things
many
change.
so-called financial professionals are like that. Like they're just gonna, human nature. They're gonna be like, let's just do this, and then they're not looking at. They don't want to have to take the time. Let's actually calculate this out. Look at all the different strategies. Run the numbers. I mean,
Right,
yeah, that's actual work, and it's a little bit of homework for you. But it could make
right,
or break your retirement.
right. And the CPA should be doing it too, but they're going to be like, well, I'm
Yes.
not a financial planner. And the financial planner is going to say, well, I'm not a tax guy.
Yeah,
And
and
then you're kind of stuck.
CPAs don't do future tax planning typically. Maybe 1 year ahead at max. They might be looking ahead to next April, but they're looking back from last year to next April at most, but usually just looking back at the past year. And
Yeah,
so that's not helping you. And
no,
financial planners are saying, "Oh, I can't. I'm not a CPA." But if you have to do future tax planning if you're a true fiduciary or financial professional because it's got to be part of your retirement plan, income plan. I mean,
I don't know how it can't be. I don't
yeah,
know how you can even say you do financial planning if you're not looking at the taxes. I mean,
Taxes play a
it,
part in everything from
everything.
Social Security to Medicare to every aspect of retirement and
Right.
finances and investments, stock portfolios, any type of account. There are always tax implications. And it's not about how much you have, it's about how much you keep. And that's why taxes are this is a huge topic, Dan.
Yeah. And do you think about it? Roth conversions is a tax problem.
Well, sure it
It's not
is.
an investment
A
problem.
Roth
It's
is a
not a
tax
policy problem.
designation by the
That's it.
IRS code. It's not
Right.
even an account. People think of
Right.
a Roth as an account, but it's a tax designation for accounts. Just
Right.
like, yeah, these are tax designations. It's all about tax.
Yeah.
Yeah.
If you want to do a Roth conversion and have a serious conversation about it and run these numbers, go through those seven I gave you. You can contact me, use the QR code, get in touch with us. We do this for our clients. We are a big proponent of long-term planning, not just put band-aid. I mean, a lot of my clients will do it. Let's rip the band-aid off. And sometimes it makes sense, but I think being strategic about it is worth it. It's a huge discussion. It's not something to take lightly. Don't just take the advice of your neighbor who did a Roth conversion. May have worked for them, may not work for you. Got to
Right.
do the math. So, Tony, thanks for a great show. We'll catch everyone next week.